holding FBGRX in your portfolio, you're paying higher fees that can cost you thousands over decades. Today, I'm going to be sharing a cheaper Fidelity growth fund that I am building up a position in. I was recently watching a video from another YouTube creator, and they recommended FBGRX as a great long-term growth fund over at Fidelity. So the ticker symbol wasn't familiar to me. I needed to go ahead and take a look. If I had in the past, I couldn't remember. So I just wanted to check and see how it compared to the fund that I'm currently investing into. I'm not just accepting any recommendation. I have to take the time to do what I'm always encouraging my viewers to do, your own research. Today, we're going to be taking a look, comparing FBGRX and the fund that I am currently investing into, FSPGX, because investing, especially long-term investing, is not about what sounds good. It's about what's truly performing and having your money work for you. All right. So here's a look at those two funds. FBGRX is the Fidelity Blue Chip Growth Fund, and it is actively managed. FSPGX is Fidelity's large cap growth index fund, and that one is passively managed. So actively managed means that a manager is trying to beat the market by picking investments, leading to higher fees because they are traded more, while passively managed means that it's going to copy a market index, which usually has more consistent long-term results along with that lower fee. So both are growth funds, both invest into large U.S. companies, both have shown strong historical performance. But here's where most people stop. But we have to dig deeper than that and get into the differences. So I'm on the Fidelity website. We're going to move over to the tab that has management and fees. Taking a look at the expense ratio for both of these funds, FBGRX has an expense ratio of 0.61, while FSPGX is at 0.035%. This is an extreme difference when it comes to these two funds. If you're not paying attention, you'll be leaving so much money on the table. These fees are going to be compounding against you the same way the returns compound for you. This is just going to eat away at your portfolio, causing so much damage. In the same video that inspired me to take a look at this fund, other funds were also mentioned, suggested as investments, but I knew the details of them off the top of my head. Always keep what I'm highlighting today in mind, whether it's QQQ, which has an expense ratio of 0.2%, while QQQM is at 0.15. Both will give you the same exposure, just one has lower fees. Or the SPY versus SPYM. The SPY has an expense ratio of 0.09%, while SPYM is at 0.02. Same index, just one has cheaper fees. I'm a long-term investor, buy and hold, building for retirement and for the future. And so those fees really matter over long periods of time. So I want to encourage you to get started investing into a fund that truly fits your long-term goals. Now, let's get back to looking at these two growth funds. FSPGX has a dividend yield of 0.31%, while FBGRX has a dividend yield of 2.65%. So this might make the managed fund, the Fidelity Blue Chip Growth Fund, seem more attractive. Yes, it pays more income. If you're building this in an IRA, those dividends are not going to be taxed. They'll be reinvested, but we have to keep our eyes open. We have to have a full understanding. The real question isn't income. It's the total return after the fees. So now let's take a look at the performance. In the past year, FSPGX has returned a little over 20%, while FBGRX is just slightly under 20%, 19.97. Then zooming out to the 5-year, the performance of FSPGX is at 16.49%, while FBGRX is at 15.52%. As you can see, we have one fund that is charging significantly more, but is not consistently outperforming even when we look at larger time frames. The lower cost index fund is quietly doing its job. And even taking a look over to the Morningstar rating column, the lower cost fund has a 5-star rating, while that actively managed fund has a 4-star rating. That perfect 5-star rating shows excellent long term risk adjusted performance. When it comes to choosing your investments, make sure that you're asking yourself one question if you come across something like this: what am I getting for this higher fee? Sometimes in actively managed funds, a particular sector, they're earning that fee that's associated with that fund or ETF. But a lot of time it doesn't. And when it comes to investing into these type of funds, the fees are guaranteed, but the performance isn't. For long-term growth, especially in my retirement accounts, I want simplicity. And now taking a look, I know that I chose the right funds for my goals and needs. It's okay to be boring when it comes to building my portfolio. I don't need excitement. I need results. An efficient way to build wealth. And when it comes to this, FSPGX is a perfect fit for my long-term strategy of incorporating a growth fund in my retirement account. When it comes to investing, you can make mistakes that aren't loud, that aren't obvious. Looking at these two funds, we can see that one with a much higher fee, but the same performance, and that higher dividend didn't make up for it either. So take a close look at your portfolio. Be aware of these things. Make the changes. Take the time to rebalance if something is not in line with your long-term goals. Something may seem small now, but think about it over decades and how it can impact you on your journey to build wealth. So thanks for watching. Leave me some comments. Let me know your thoughts. Check out my referral links. They'll be in the description as well as pinned in the comments. Make sure to like, subscribe, hit that notification bell. Okay, bye.